the $140 trillion market setting the price of your financial life, and why nobody told you every time the Federal Reserve raises interest rates by 1%. Roughly $3 trillion in bond market value disappears, not cryptocurrency, not speculative technology stocks, bonds, the asset class most investors have been conditioned to ignore. And here is the part that almost nobody connects. You do not need to own a single bond for this to systematically affect your mortgage affordability, your retirement timeline, your stock portfolio returns, and the purchasing power of every dollar you have ever saved. The bond market is doing this to you right now. It has been doing it throughout your entire investing life. And once you understand the actual mechanism, you will look at every financial decision you have made completely differently. The US stock market, the thing most retail investors track daily, is roughly $48 trillion in size. The global bond market is approximately $140 trillion, nearly 3 times larger. And while the average investor checks stock prices before they check their email, most of them have never once looked at a bond yield. That is not a minor oversight. The bond market sets the price of money itself. It determines your mortgage rate, shapes your 401k returns, influences whether your employer can afford to expand, and signals what the most sophisticated institutional investors in the world expect to happen to the economy over the next 12 to 24 months. The financial media spent 2 decades framing bonds as dull, something your grandparents held, something you shifted into when you were too cautious for real investing. While that narrative ran, the bond market quietly determined the shape of your financial life, in public, with free data on government websites. While everyone watched the stock ticker, gravity, the one metaphor that explains everything before the mechanics, one idea worth holding for everything that follows. Think of the bond market as gravity, not a background variable, not a dial you adjust occasionally. Gravity, stocks, real estate, index funds, private equity, they all appear to be flying freely, making independent decisions based on earnings and growth narratives and market momentum. But every single one of them is in orbit around the bond market. When gravity shifts, when yields move, everything adjusts. Not immediately, not visibly at first, but always and inevitably. The mistake that costs most investors the most money is not picking the wrong stocks or paying excessive fees. It is spending all their time analyzing the orbiting planets while never considering the force actually pulling them. Before making any significant financial decision, the first question worth asking is, where is gravity right now? What are bond yields doing? That single question tells you more about the near-term outlook for stocks, real estate, and credit conditions than any earnings report or investment newsletter. How the bond market moves your stock portfolio here is the concrete mechanism that most investors have never had explained to them clearly. When you buy a stock, you are making a judgment that the company will generate returns sufficient to justify the risk you are taking. But those expected returns have to be compared against something, a baseline. That baseline is the risk-free rate. What you can earn by lending money to the US government with essentially zero chance of not getting it back. In early 2026, the 10-year US Treasury yield sits at approximately 4.4%. That means you can lend money to the federal government for 10 years and collect 4.4% annually, with effectively zero default risk. If you are going to buy stocks instead, assets that carry real risk of earnings disappointment, sector disruption, and market volatility, you need to believe you will earn meaningfully more than 4.4% to justify taking that risk. The gap between expected stock returns and the risk-free rate has a name: the equity risk premium. Historically, it has run around 3 to 5 percentage points above the risk-free rate, meaning stocks should deliver roughly 7 to 9% annually to justify their existence in a world where the alternative pays 4.4%. Now run the same logic backward to 2021. Bond yields were near zero. The 10-year Treasury sat at 1.5%. In that environment, even if stocks returned 5 or 6%, the equity risk premium still looked attractive. Stocks could afford to trade at very high valuations, and they did. The price-to-earnings ratio on the S&P 500 reached levels not seen in decades. In a near-zero rate world, paying a high price for future earnings is almost rational, because the alternative is 1.5% on a 10-year bond. Then rates rose to 4.5% in under 12 months during 2022. The most aggressive tightening cycle in 4 decades. Suddenly, those same stocks priced for a near-zero rate world looked dramatically overvalued relative to the new risk-free return. The broad repricing that followed was not a sentiment crash or a crisis of confidence in any particular company. It was the gravitational field readjusting. Investors who had never tracked a bond yield in their lives watched their diversified portfolios fall 20, 25, 30%, not because the underlying companies had deteriorated, but because the bond market changed the rules of valuation and nobody had told them to watch for it. The signal nobody mentioned, the yield curve there, is a signal inside the bond market that has anticipated every US recession since the 1960s, every single one. It has been available for free on a government website throughout that entire period. It received almost no coverage in mainstream personal finance media during the years when it mattered most. It is called the yield curve. The US Treasury issues debts at different maturities: 3 months, 2 years, 5 years, 10 years, 30 years. Each carries its own yield. Under normal conditions, longer-term bonds pay more than shorter-term ones. You expect additional compensation for committing your capital for a longer period. 10-year bonds yield more than 2-year bonds. That is the standard shape. Sometimes, the relationship inverts. Short-term yields rise above long-term yields. The 2-year Treasury pays more than the 10-year. This sounds like a technical footnote. It is the most historically reliable recession signal the financial system produces. When sophisticated institutional investors, the largest pension funds, sovereign wealth funds, and banks in the world expect economic deterioration ahead, they move capital into long-term government bonds. High demand drives those prices up and yields down. Meanwhile, if the Federal Reserve is holding short-term rates elevated to fight inflation, short-term yields stay high while long-term yields fall. The curve inverts. This inversion represents the bond market, the most information-dense, institutionally sophisticated market on the planet, collectively pricing in economic deterioration with actual capital at risk. The yield curve inverted before the 2001 recession, before the 2008 financial crisis, before the 1990 recession, before the early 1980s recession, before every significant economic contraction in living memory, and all of it was visible in real time on publicly available Treasury data. Staying the course through market volatility is sometimes sound advice, but informed investors deserve to know when the bond market is broadcasting a warning signal, not because they should panic, but because the signal creates an opportunity to make measured, deliberate adjustments rather than reactive ones. What the current environment actually means for your portfolio. The United States national debt currently stands at approximately $37 trillion. The country runs an annual deficit, spending more than it collects of roughly $1.8 to $2 trillion per year. The debt-to-GDP ratio sits around 122%. Roughly a third of that debt is short-term and needs to be refinanced in the coming years, rolled over into new bonds at whatever the prevailing yield happens to be. When rates were near zero, that process was cheap. Now that rates sit in the 4 to 4.5% range. The carrying cost of existing debt has become a structural issue. The Congressional Budget Office has projected that annual interest payments on U.S. government debt would exceed $1 trillion more than the defense budget, more than Medicare, more than Medicaid, spent entirely servicing past borrowing rather than building anything with forward economic value. Consider what this means practically. The government has a fixed revenue base. A growing portion of that revenue now goes to interest payments rather than productive investment. When it needs additional funding, it issues more bonds. More bond supply creates upward pressure on yields to attract buyers. Higher yields mean more expensive borrowing for everyone: households, businesses, municipalities, banks. More expensive borrowing slows economic activity. Slower activity pressures corporate earnings. Pressured earnings pressure stock prices. The loop is self-reinforcing and entirely visible if you know where to look. What the same environment is offering you right now, here is the part most investors focus on least. The same yield environment that compresses long-term equity return expectations is simultaneously offering something not available since 2007, a genuinely attractive risk-free return. Short-term Treasury bills in early 2026 yield approximately 4.2 to 4.5%. No duration risk, no credit risk, no volatility to manage. And because interest on Treasury securities is exempt from state and local income taxes, the after-tax yield is meaningfully better than an equivalent return from a corporate bond or a standard bank savings account, particularly for people in high-tax states. Major retail banks are currently paying somewhere between 0.4 and 0.5% on standard savings deposits. while investing those same deposits in instruments earning considerably more. The gap between what they collect and what they pay depositors is the business model. It operates entirely on customer inertia, on $100,000 sitting in a standard savings account earning 0.5% instead of 4.5%. The difference is $4,000 per year, compounded over 9 years. The gap between an idle cash position and a short-term treasury approach exceeds $40,000 on money you already have sitting somewhere doing almost nothing. Gravity works in both directions. The same mechanism that pressured equity valuations in 2022 is now offering legitimate compensation for capital you are holding in reserve. The investors who understood what was happening saw this opportunity in 2022 and moved idle cash from near-zero savings accounts into 4 to 5% treasuries, while everyone else was focused on the equity market decline and debating when to buy back in. Accessing treasury bills does not require navigating an obscure government portal. They can be purchased through any major brokerage platform in a few clicks, the same way you would buy a stock. How this changes your retirement math. Consider 2 scenarios for someone 45 years old with $250,000 in retirement savings and $800 per month in ongoing contributions, 20-year runway to retirement. In 2021, when the 10-year Treasury sat at 1.5%, a realistic expected annual return on a 60-40 portfolio was approximately 7 to 8%. Run $250,000 plus $800 per month for 20 years at 7.5%, and the ending balance approaches $1,400,000. Now update the environment to early 2026 with the 10-year Treasury at 4.4%. The bond portion of the portfolio earns a real return for the first time in 15 years, which is genuinely positive. But the equity portion faces persistent valuation pressure from elevated discount rates, and realistic expected returns on the same 60-40 portfolio sit closer to 5 to 5.5%. Run the same scenario at 5.5%. The ending balance is closer to $1,030,000. The gap between those two outcomes is approximately $370,000 at a 4% annual withdrawal rate. That difference translates to $14,800 less per year in retirement income every year for the rest of your life. That gap was not created by poor stock selection or high expense ratios. It was created by using a return assumption calibrated to a gravitational environment that no longer exists. The bond market changed, the projection did not update, and the person using that projection will not discover the discrepancy until they are 65. And the spreadsheet does not match the account balance. The instrument panel. 3 numbers that matter. None of this requires becoming a bond investor or spending hours studying fixed income markets. 3 numbers, checked periodically, provide more genuine insight into the macro environment than most of what financial media produces daily. The first number is the 10-year Treasury yield. Check it the way you check the major stock indices. In early 2026, it sits at approximately 4.4%. Above 4% means growth assets face genuine competition from the risk-free alternative. Equity valuations are under constant pressure in this environment. If it climbs toward 5 or 6%, financial conditions are tightening significantly and something in the credit markets usually cracks. If it drops quickly toward 2 or 3%, the institutional money is moving to safety, often an early signal of stress that has not yet appeared in equity prices. The second number is the spread between the 2-year and 10-year Treasury yields. This is the yield curve in its most practical form. When the 2-year yield exceeds the 10-year, when the curve is inverted, historical precedent suggests elevated recession probability within 6 to 18 months. This is not a signal to liquidate everything. It is a signal to be deliberate, reduce unnecessary leverage, hold slightly more cash than usual, and confirm that your near-term allocation can absorb a stress scenario without forcing you to sell at the wrong moment. The third number is the high-yield credit spread, the premium that lower-rated corporate bonds pay above Treasury yields. When this spread widens sharply, the bond market is pricing rising default risk among weaker borrowers. Credit spreads typically blow out before equity markets fully reprice. It is a leading indicator that shows up in fixed income before it shows up in stock prices. 10-year yield 2-10 spread, high-yield credit spread. 5 minutes once a week with those 3 numbers provides a more accurate picture of where the macro environment is heading than most retail investors get from daily stock market consumption. The stock market tells you what is happening now. The bond market tells you what the most sophisticated investors in the world expect to happen next. 3 things to do this week, not eventually. This week. First, go to the Treasury's website and find the daily yield curve rates. Look at the 2-year and 10-year yields. Calculate the spread. Write it down. Check it again in 30 days. This takes 4 minutes and gives you access to the same signal that institutional investors spend enormous resources trying to act on faster than each other. You get it for free. Second, find the return assumption underlying your current retirement projection, your 401k target, your advisor's model, your target date fund's expected glide path. If that assumption sits above 6.5 to 7%, ask what bond yield environment it assumes. If the answer is vague, or if the model was built when rates were near zero, your projection may be meaningfully optimistic for the current environment. Discovering this now, with time to adjust contributions or recalibrate expectations, is categorically better than discovering it at 60. Third, move your idle cash off the standard bank savings rate. In early 2026, short-term treasuries yield 4 to 4.5% with no credit risk and meaningful state tax advantages. The difference between a standard savings account and a short-term treasury position is currently substantial. On $50,000 in cash, the gap is potentially $2,000 per year, money you are effectively transferring to your bank rather than keeping in your own account. The bond market has been setting the price of your financial life for years. Your mortgage rate, your stock returns, your inflation-adjusted retirement projection, your employer's borrowing costs, all of it determined in a market you were told was too dull to understand. Now you understand it. Gravity exists whether you measure it or not. The only question is whether you are reading the instrument panel or flying blind and calling it confidence.